Shibani, good to be speaking with you. A very good morning. And firstly, Shibani, help us with your take. How do you analyze the markets right now? Because of late, the markets have been consolidating at those higher levels, waiting for some more clarity on what could happen to the tariff. And the earnings season is also in full swing. What factors are at play for the markets, and what sentiment are you catching the hold of right now?
Hi, good morning. Pleasure to be on your show. So, if you look at Indian markets over the last year or so, our markets have been fairly resilient in the backdrop of what's happening globally with all the tariff related uncertainty and geopolitical tension. Having said that, if you look at calendar year to date on a relative basis, if you look at Indian markets, they have somewhat underperformed the emerging market pack. In that context, when you look at our markets today, if you look at the macro factors, macro and policy factors continue to remain fairly buoyant, and policy has been supportive. We have been seeing improvement, especially as far as the rural consumption trajectory goes, with income improving. However, I think the biggest factor to watch out from our market perspective, apart from the global factors that we have been discussing, is what happens to corporate earnings. All of last year, we saw muted trends in terms of corporate earnings delivery with low single digit earnings growth for FY25. And we were also seeing earnings downgrades every quarter. And I think that has led to our markets today trading at valuations, which, if you look at Nifty at over 22 times 1 year forward earnings, is close to fair value range. The mid caps are trading at slight premium to their long term history, and the small caps are trading at a significant premium to their long term history. So, for our markets from here on, earnings delivery becomes crucial. In this quarter, which is the first quarter, our expectations are of mid single digit earnings growth. But when you look at the full year as a whole, which is FY26, at this point in time, expectations are of improvement of close to double digit earnings growth for the year as a whole. So, therefore, delivery of earnings in this context of valuations becomes important. And hopefully, from here on, in the second half of the year, you should start seeing improvement as far as corporate earnings goes.
Right, okay, Shibani. Hi, morning. This is Nehi also joining in. And I'm taking a look at your weightage on equities. Like you just mentioned, you're marginally underweight on mid cap and underweight on the entire small cap space. But recently, the trend in the market that we're spotting is that every time there is a little bit of an upsurge, it's actually the broader end of the market that's doing much better compared to the benchmarks. What could be a trigger other than valuations? Could it be earnings? Could it be some other factors that could lead to you resetting your view or your weightage on the Smiths basket?
So, as far as the Smiths are concerned, it's not that we've been completely avoiding the space. It has been more bottom up in nature, looking at companies where there is visibility in terms of earnings delivery. As we were discussing, in terms of valuations, especially the small cap past, the index is trading at a much higher premium as compared to its long term history. And therefore, a lot of the movement that you've seen in that segment has been on the back of multiple re rating. Earnings delivery has played a role in some few cases. However, a lot more multiple re rating has resulted in the movement that you've seen in the broader market space. And therefore, from here on, earnings growth becomes important. If you look at even last quarter or the full year of last year, when you look at the earnings delivery, small caps specifically as a overall basket saw disappointment in terms of earnings, and therefore multiples just keep re-rating without the earnings actually playing through. So therefore, our overall strategy where the small and mid caps have been is to look at stocks more bottom up in nature, look at companies with strong balance sheets, and look at companies where there is earnings delivery, but today trading at reasonable multiples. And therefore, our view is that if earnings growth does pick up and there is more broad basing of earnings, therefore, that is then the segment will possibly start getting more attractive because then the valuation multiples because of earnings delivery will start looking more favorable.
Shibani, does it make sense to look at bottom-up stories, or would you say stick with there where there is, earnings visibility? Case in point being IT. Should one be looking at that sector right now?
Yeah, so absolutely. So bottom up stories do make sense, as especially when you're looking at the small and mid cap segment, you have to be a lot more stock specific in nature rather than look at the entire basket. Where IT is concerned, our view on IT is that yes, there are near-term headwinds, primarily because of uncertainty on discretionary tech spend, where large geographies such as Europe and North America are concerned. However, when you look at the commentary of some of the companies that have already reported earnings for this quarter, commentary seems to suggest that A, the macro environment is not worsening. B, in large verticals such as BFSI, you are seeing steady improvement, especially where North America BFSI is concerned. And therefore, our belief is that as and when we get closer to some sort of settlement where all the trade related tensions are concerned, some amount of the discretionary tech spend, which has been missing in action for so long, possibly does come back, and that leads to earnings and revenue growth for the sector normalizing in line with their long-term trajectory. The second aspect is that within the sector, there are pockets where valuations are fairly reasonable. And the third aspect is from a slightly longer term perspective. If you look at what's happening on the AI segment, AI and adoption of AI by enterprises globally, our view is that that will lead to, over a period of time, considerable amount of work for the Indian IT services space, specifically for those companies who are able to evolve and build talent and capabilities to cater to that demand. So IT at this point in time, in the near term, will possibly see some headwinds, but with a medium term view, our view on the sector remains fairly constructive.
All right, that's about IT. But Shibani, off late, the consumption basket is seen to be picking up, and especially the case of staples. That's garnering some bit of an investor interest. Yes, after that, decent Q1 updates coming in from select companies. What's your own sense on the consumption basket? Have you made any adjustment with respect to the staple basket or the allocation over there, or within consumer discretionary, any particular pocket that you're liking at this point in time?
Yeah, so if you look at the overall consumption space, that's in a space which has been a laggard for the last couple of years. Within the segment, our preference has been for the discretionary basket over staples. Though, of course, in staples, there are some segments where valuations are looking relatively attractive, especially when you look at long-term averages. A couple of things on the consumption side. One, of course, the monsoons have been progressing well. If you look at the data on food grain sowing, that seems to suggest that the output on food grains and crops should be good for this year. Secondly, if you look at real rural wages, after a long period of time, real rural wages seem to be on an uptick. And of course, inflation, especially food inflation being under control, is helping there. So that's the second aspect overall. And the third has been the policy support, both in terms of the budget and the tax benefits that have come through for the middle income segment, as well as the rate cuts that have been announced by RBI. So our belief is that if you look at the mass or the middle income segment, that's where the consumption basket should start to improve as we progress through the year. Then, of course, the festive season and the like, which is more, time bound and cyclical in nature, which should come through. So therefore, if you look at our preference within the consumption basket, a preference has been for discretionary consumption, especially that end of discretionary consumption, which is more mass or middle income in segment. So for instance, two-wheelers, some parts of consumer durables, airlines, retail, these are segments that we think that where the trajectory in terms of growth and earnings should improve, given that there are initial and nascent signs of some amount of consumption coming back.
Shibani, appreciate that view, and thank you so much for joining us and taking the time out to speak to us at ET Now. On that note, we'll let you go.